This is the Nedgroup Investments Insights podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Welcome to another episode of Inside the Mind of a Fund Manager. I'm Mansoor Narker, Senior Investment Analyst at Nedgroup Investments. Today we're picking up on a topic we briefly touched on in our last episode. In what has become known as Saaspocalypse, software and data companies have recently been sold off hard as investors begin to fear that AI is going to disrupt and wipe out entire business models. To unpack this, my guest today is Andrew Headley, Portfolio Manager of the Nedgroup Investments Global Equity Fund. Welcome, Andy.
Good morning.
To set the scene, markets have become very binary on AI. As you well know, Andy, companies seen as AI winners get rewarded, and anything perceived as vulnerable, especially software and data providers, gets sold, often indiscriminately. Why do you think investors have fallen into this trap?
I think that's a really interesting question. And so we have definitely seen that anything that is software related has been impacted by AI. And I think the reasoning is that it's very simplistic. I think that the thought process behind it is that it's acknowledged by most people that artificial intelligence and these frontier large language models are good at coding. And obviously software is basically coding. And so if LLMs can do the coding, then that must mean that all software companies are vulnerable and will get disintermediated. And so consequently, all software companies have sold off. And so I think it's been very indiscriminate. But we at Veritas don't think it's going to be quite as simplistic as that. We think it's far more nuanced. And whilst we would accept that the range of outcomes has widened, I think that's a relatively fair assertion. We think that there is, within software, there is a continuum. And across that continuum, there are some companies that we think are well protected against competition from LLMs and AI, and other companies where they are likely to get disintermediated, or at least a large part of their business will get disintermediated. So we think that there is some validity to the sell-off of software, but we think it's been too simplistic, not nuanced enough, and that people have not, or investors have not, taken account of the different attributes of different types of software.
Now to the core point, all software is not the same. In your portfolio, you've owned businesses like Dassault Systems, SAP, Intercontinental Exchange, Salesforce, different in markets with all of them, but each deeply embedded in workflows. What makes a true systems of record resilient, especially when everyone's worried AI will disintermediate them?
Yeah, so this comes back to the point that I was making earlier about there being a continuum. So even within our holdings, we think there's a continuum in terms of how secured they are against competition. So systems of record are inherently resilient. So as I've said, they are the source of data truth within an organization. They require integrity, consistency, compliance, and accuracy. So that 5 nines accuracy I spoke about, well, Gen AI is nowhere near that level of accuracy. Gen AI still has a tendency to hallucinate. And depending on who you believe, Gen AI can hallucinate somewhere between 15 and up to 50% of the time. And so it doesn't have that accuracy level. So it's unlikely that a system of record is going to get replaced anytime soon by something that is just not as accurate. But we think there are other reasons why systems of record are resilient. First of all, as you point out, they are embedded in workflows. So they're like, these systems are like the plumbing of a company. And to change them would be like ripping out the plumbing or having open heart surgery. So they're typically integral to the operations of a business. I've already touched on the fact they're highly deterministic. So they require 5 nines accuracy. There's often a compliance element for these systems. So take SAP. There's a large element of compliance within that. And also there's quite a large degree of customization. So we think there's a large number of reasons as to why systems of record will not be replaced easily. There's a couple of more nuanced points I would make as well, which are that the data within a system of record has context. So for example, you may be able to extract the data to say there's been a sale. So maybe there's been 2 sales that you can extract. But you might not have the context around those sales once you extract it. So, for example, one of those sales may have been delivered via a third-party delivery company, and one of them may have been delivered by the company or maybe collected in store or a different type of delivery method. That context will be lost when it's extracted from the system of record. And so these systems of record typically have far more granularity and context than you could achieve if you extract it. And so an LLM that is working on the data can only get access to what is allowed through an API or that is extracted from the system of record. And so they will likely lose a lot of the context, which is very important. So we think that the companies we have are well protected. But as I say, there is a continuum. And for us, we think SAP, which is the globally dominant ERP provider, particularly to complex organizations in the manufacturing space and pharmaceutical space, etc., we think that they are very highly protected. And then we have Amadeus, which we think is also very highly protected in airline IT and a global distribution system. It's much cheaper to do a search on a GDS than it is to use an LLM. So it's around 30 times more expensive, we believe. So we think Amadeus is well protected. We then have Dassault Systèmes, which is sort of the de facto CAD/CAM software for various industries, but particularly autos. Again, hard to displace, partly because they have the history.
Thanks, Andy. Speaking of disruption, the team has recently sold Alphabet from the portfolio. Talk us through how you came to this decision, and are you buying further into the software weakness and the names that you currently own?
Yeah, it's a very good point. We have recently sold our Alphabet holding. Just to be clear and to highlight our long-term investment philosophy is we have held Google, Alphabet, as it became, continuously in the fund for over 15 years. So we are being a very long-standing investor in Alphabet, and it's been a very successful investment. And so we have sold it. And the reason we've sold it is we think that whilst it is likely to be one of the AI winners, they have probably the finest AI engineering on the planet. So they are well placed, undoubtedly, for this new AI paradigm. Our concern comes from where they generate their revenue. So around 90% of Alphabet's profits come from digital advertising. Digital advertising has obviously thrived over the last 10 years or so, taking an increasing amount of the global advertising market. Depending on which research outfit you believe, it's somewhere around 3/4 of total advertising is now digital advertising, and Google, Alphabet dominates that. And we believe that these new LLMs, we think it's certainly at the moment, it appears as though there will be 5 or 6 LLMs with similar functionality, right? We haven't got to the stage where any LLM is markedly better than any of the others. And so they leapfrog each other in terms of performance, but nobody has got markedly better for a sustainable period. And so we think we'll end up with a number of LLMs, and we think some of those will want to get revenue from digital advertising. So they will emulate Alphabet. And that means there is likely to be at least one and maybe more new competitors in the digital advertising field. And we feel like the digital advertising field, whilst it can expand, it can't expand that much further. It's already, as I say, probably 75% of total advertising is digital advertising. So we worry that with a new competitor in digital advertising, it will have an impact on Alphabet's overall advertising. And as I say, 90% of Alphabet's revenue comes from digital advertising content. So that's our concern. Obviously, over the last year in particular, so actually since Liberation Day, Alphabet has performed exceptionally well. It went from being seen as an AI loser in kind of March, April 2025 to an AI winner during late 2025 and early 2026, such that the share price performed exceptionally well over the last 12 months. And so the valuation has increased markedly at the same time as we believe the potential for competition has increased markedly. And so it's come down to a valuation question for us, in that the valuation is now no longer compelling for us to want to continue to hold it, particularly as we think OpenAI is likely to be a new competitor in digital advertising. So we've taken the decision to sell that, and we are slowly increasing our exposure to a mixture of things. One is the software companies that have been sold off. And the other is the data and analytics businesses that have also been sold off in this AI, let's call it enthusiasm. And people are worried about that the data and analytics companies are also going to get disintermediated. And we feel that, again, like the software companies, some of those are well protected. And so we are increasing some of our positions there. And that's companies, a good example would be LSE, so LSEG.
Thank you for your insights and analysis today, Andy. We'll leave it there. If someone remembers one thing from today, it's this. Software is not one big bucket. Systems of record, deeply embedded, high switching costs, high governance, are very different from more replaceable tools. And in a market dominated by a single AI narrative, that nuance can matter. To our listeners, thank you for tuning in. Until next time, stay informed and stay invested.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.